The minutes of the June meeting of the Federal Open Market Committee, released last week, indicated that, despite the unanimous vote to pause the rate hiking campaign in June, a sizable portion of the committee seemed very open to delivering another rate hike in June. We suspect those committee members will become more vocal about increasing rates in the remaining 4 Fed meetings this year, especially if the Fed's key inflation indicator stays near current levels. Let's take a closer look. The minutes showed that some committee participants preferred or could have supported a hike in June. Our own view is that some of these participants were voters who, consistent with the consensus-driven culture of the committee, were reluctant to rock the boat and go against the majority view. In addition, some of these participants could have been non-voters who would have voted against pausing in June if they had a vote. The undercurrent of sympathy for a hike in June was all the more remarkable given policymakers' views on the outlook for the U.S. economy then. Most participants saw risks to economic growth as tilted to the downside. Even more telling, they acknowledged the possibility that their own actions could contribute to a more pronounced slowing in economic activity than they were anticipating. The Fed staff was more explicit on this possibility, reporting that tight financial conditions would likely contribute to a mild recession starting later this year. What was behind the sentiment toward a June hike, even as risks to economic activity remained to the downside? It all came down to inflation. The minutes showed that committee participants reported seeing, thus far, no sustained easing in underlying inflation this year. Participants generally still saw the labor market as very tight and as a likely contributor to persistently high inflation. Investors keen on the future path of monetary policy would do well to look through the June pause and seriously consider the possibility that we are at least 2 25 basis points hikes away from the end of this tightening cycle. That's more than what seems to be priced in the federal funds futures market, which points to a net rise of just 25 basis points for the remainder of this year. We view 2 additional hikes this year as especially likely if core inflation, as measured by the Fed's preferred personal consumption expenditures price index, remains near its current readings.